Analog Devices just reported the kind of quarter that normally makes Wall Street throw confetti. Revenue jumped 40%. Earnings surged. Margins hit extraordinary levels. Management raised the bar again for next quarter. Analysts rushed to increase price targets. And then the stock fell. That, my friends, is where this story gets interesting. Analog Devices, ticker ADI, closed August 21st at about $373. My conclusion is simple. This is an exceptional company, but the stock is much less obvious. The business deserves extremely high marks. The valuation does not. So I'm bullish long-term, but at today's price I'd rather accumulate on weakness than chase a fantastic earnings headline. First, what does Analog Devices actually do? It makes analog semiconductors. Digital chips do the computing. Analog chips connect that computing to the messy physical world. Temperature, sound, pressure, motion, electricity, radio signals, machinery, cars, and sensors. ADI sells more than 75,000 different products that help electronic systems measure, control, and communicate with the real world. And analog chips have a beautiful economic feature. Imagine a $20 component buried inside an industrial machine worth $100,000. Once engineers have tested that component, qualified it, and designed the whole system around it, nobody wants to redesign the machine to save 50 cents. That makes these chips surprisingly sticky, with long product lives, good pricing power, and very attractive margins. ADI is also nicely diversified. In the latest quarter, industrial customers produced 49% of revenue, automotive was 25%, communications was 16%, consumer products were the remaining 10%. So while artificial intelligence is becoming increasingly important, this is not a company whose entire future depends on one fashionable corner of the technology market. Now, the quarter itself was spectacular. Fiscal third quarter revenue reached $4.02 billion, up 40% from a year earlier. Industrial revenue rose 53%, automotive grew 16%, communications exploded 84%. Even consumer revenue managed 6% growth. This wasn't one hot division dragging everybody else along. Profitability was even more impressive. Adjusted gross margin reached 72.5%. Adjusted operating margin hit 50%. Adjusted earnings per share came in at $3.45, up 68%. 3 months earlier, management had guided for roughly $3.9 billion of revenue and $3.30 of adjusted earnings. They beat both. And the cash is real. Over the trailing 12 months, ADI generated about $5.55 billion in operating cash flow and $4.94 billion in free cash flow. That free cash flow was equal to 36% of sales. For a company selling physical hardware, converting more than 1/3 of revenue into free cash is pretty remarkable. Management then looked at this monster quarter and basically said, "Nice, now watch the next one." For the fourth quarter, ADI expects around $4.3 billion of revenue, an adjusted operating margin near 52%, and adjusted earnings around $3.86 per share. Revenue has gone from $3.16 billion in Q1 to $3.62, then $4.02, and now potentially $4.3. So yes, the momentum is real, but we need to talk about AI because this is where investors can get carried away. Data centers now represent about 80% of ADI's communications business. Communications is 16% of total revenue. That means data centers alone are roughly 13% of the company. Broaden the definition to include semiconductor testing, and management estimates overall AI exposure around 20%. 20% is important. It is not NVIDIA, and I actually like that. ADI benefits from AI without requiring every dollar of revenue to come from selling the hottest processor on Earth. Its products help manage power, monitor systems, move data through optical networks, operate racks, test chips, and connect increasingly power-hungry computing equipment to the electrical infrastructure around it. That power problem could become a very big deal. The more electricity an AI accelerator consumes, the more painful every tiny inefficiency becomes. Lost electricity becomes heat, and heat becomes an engineering nightmare. ADI's data center optical and power businesses each grew more than 100% year-over-year in the third quarter. Management expects data center revenue to keep growing in the fourth quarter. That brings us to Empower Semiconductor, ADI bought the company for $1.5 billion in cash, completing the acquisition in July. Empower specializes in technology that brings voltage regulation and power delivery closer to the processor itself. In simple English, if future AI chips need absurd amounts of electricity, Empower could help deliver that power more efficiently. The acquisition fits ADI's strategy beautifully, but I'm not giving management a trophy yet. $1.5 billion is manageable against roughly $5 billion of annual free cash flow. Still, fashionable AI assets tend to become expensive very quickly. I want to see actual customer design wins turning into revenue before assuming Empower deserves some heroic valuation. Here's the part I think deserves more attention. There may be another recovery happening underneath the AI story. Management says many ordinary customers are still carrying unusually lean inventories, and much of the non-AI business remains below normal historical consumption. In other words, traditional industrial demand may still have room to recover even after ADI's enormous recent growth. The competition supports that argument. Texas Instruments recently reported 23% revenue growth, Microchip reported 38%, NXP grew 19% across its end markets. So this is not simply one company riding an isolated AI wave, the broader analog semiconductor cycle appears to have turned upward. That creates an interesting possibility. Suppose AI growth eventually slows. Everybody immediately imagines ADI falling off a cliff. But what if industrial, automotive, and traditional communications customers are recovering at exactly the same time? A slower AI business could be partly replaced by healthier demand elsewhere. That would make overall growth more resilient than the simple AI bubble argument suggests. Still, I refuse to forget one phrase: semiconductor cycle. These businesses have been cyclical for decades. ADI itself went from about $12.3 billion in fiscal 2023 to $9.4 billion in 2024, then back to $11 billion in 2025. Wall Street now expects roughly $15 billion this year and close to $18 billion next year. So investors are taking a company that recently went through a severe inventory correction and projecting it toward almost twice its fiscal 2024 revenue within 3 years. Maybe that happens, but when everybody starts drawing straight lines upward in a cyclical industry, I start checking whether somebody has hidden the eraser. Margins are another place where enthusiasm needs discipline. Management expects adjusted gross margin around 74% in the fourth quarter. That is absurdly good. Higher factory utilization, strong data center products, pricing, acquisition synergies, and operating leverage are all helping at once. The danger is obvious. Several wonderful things may currently be happening simultaneously. If sales weaken, factory utilization can hurt margins instead of helping them. If the product mix becomes less favorable, margins can decline. If competitors add capacity, pricing becomes harder. Management has also acknowledged that a lot of the easy utilization benefit has already been captured. So I would treat 74% as a possible high water mark, not something to casually extend forever in a spreadsheet. The balance sheet itself looks manageable. ADI has roughly $2.3 billion in cash, around $9.2 billion in debt, and management puts net leverage near 0.9 times. I'm much more interested in inventories. The company is deliberately building inventory to prepare for demand, while distributor inventories have also risen. That can be exactly the right decision during a boom. It can also become the beginning of the next semiconductor inventory problem. For now, management says customer inventories remain lean and book-to-bill is above 1, meaning new orders are running ahead of shipments, so there's no obvious alarm. But inventory growth is something I'd watch every single quarter from here. Wall Street, meanwhile, has fallen head over heels. 34 analysts currently produce a strong buy consensus with an average price target around $463. Several major firms raised targets immediately after earnings, some toward $500. Bernstein analyst Stacy Rascon has even argued that $20 of earnings per share in fiscal 2028 is plausible. I agree with a lot of what the analysts see. The analog recovery is real. AI infrastructure genuinely needs more power management, optics, and testing. The cash generation is excellent. And given current bookings, backlog, and fourth quarter guidance, another growth year in fiscal 2027 looks very plausible. But this is one of the oldest habits on Wall Street. Analysts often become most confident after the evidence becomes obvious. Being bullish before a recovery can get you fired. Becoming bullish after revenue jumps 40%, gross margins cross 72%, and free cash flow hits records is much safer. Consensus can become safest for the analyst precisely when it becomes least useful for the investor. And that brings us back to the stock reaction. ADI had already risen about 52% over the previous 12 months. Then the company beat revenue, beat earnings, delivered 40% growth, raised guidance, projected higher margins, and triggered more analyst optimism. The shares still fell about 0.9% on earnings day. This is investing lesson number 1007. Markets do not reward good news. They reward news that is better than what the price already assumes. A company can report an incredible quarter and still fall because investors were expecting something even more incredible. When almost flawless news cannot push a stock higher, expectations deserve your attention. That does not mean short ADI, far from it. Around 92% of the shares are institutionally owned, and short interest is only about 2%. Big investors have plenty of reasons to like this company. Strong cash flow, AI exposure, industrial exposure, dividends, buybacks, and less technological all-or-nothing risk than a cutting-edge processor designer. But institutional love can also keep a stock expensive. Pension funds and giant asset managers do not need ADI to double next year. They can happily own a high-quality compounder at a premium valuation. And if Treasury yields suddenly jump, those same institutions may sell expensive semiconductor stocks simply because valuations are compressing, even when the factories themselves are doing perfectly fine. Here's my favorite bullish contrarian argument. AI compute could slow before AI infrastructure slows. Maybe hyperscalers eventually decide they have enough processors for a while. They would still need electricity, power conversion, cooling, networking, optical connections, and grid capacity to make all those processors useful. ADI operates right in the middle of several of those bottlenecks. And because management categorizes only around 20% of the business as direct AI and automated test exposure today, industrial and automotive recovery can remain separate growth engines. So I don't love the lazy argument that everybody likes AI, therefore AI must be a bubble, therefore ADI must be a sell. Reality can be more complicated than a slogan. The bearish argument is more interesting too. ADI may simply be a wonderful company experiencing peak everything at once. Peak cyclical growth, peak factory utilization, peak AI enthusiasm, peak pricing power, peak product mix, peak margins, and nearly peak analyst enthusiasm. None of those things needs to collapse. They merely need to become a little less perfect. That is how investors lose money in great companies. The business can keep growing while the stock disappoints because buyers paid for a future that was too smooth. At roughly $373, ADI traded around 23.5 times forward earnings and roughly 36 times free cash flow, giving investors a free cash flow yield of only about 2.7%. That valuation is not insane for a business this good. But it isn't cheap either. The price works nicely if ADI becomes a dependable high single-digit or low double-digit earnings compounder after this recovery. It becomes much less comfortable if fiscal 2027 turns out to be somewhere near the top of the semiconductor cycle. Using Wall Street's current fiscal 2027 earnings estimate of about $16.11 per share, the research gives us three useful long-term scenarios. In a bear case, modest earnings declines and a 19 times multiple could produce a fiscal 2031 price around $282. In a base case, 8% annual earnings growth and a 23 times multiple gets you near 504. The bull case is much more exciting. If earnings grow around 13% annually and investors still pay 27 times earnings in fiscal 2031, the stock could reach roughly $709. Add dividends and the base case points towards something around a high single-digit to roughly 10% annual total return from today's price. Respectable? Yes. Screaming bargain? No. Price changes the argument quickly. Around $370, I think the stock is reasonable but offers limited margin of safety. Around $335 to $340, the valuation becomes much more attractive. Around 300 to 310, I'd find the risk and reward very compelling, assuming the fundamental story remained intact. Above roughly $430, I'd demand stronger evidence that earnings above $20 per share and gross margins above 70% can persist beyond fiscal 2028. These are not magical chart levels. They are simply places where the relationship between business quality and the price you're being asked to pay changes substantially. For the next 6 to 12 months, I'd focus on a few things. Can data center growth remain strong without having to double every year? Does industrial demand keep recovering? Can gross margins stay somewhere around the low 70s? Does book-to-bill remain above 1 while inventories stay healthy? And most importantly, do fiscal 2027 earnings estimates continue rising or start getting cut? I also want evidence from Empower Semiconductor. PowerPoint slides about enormous future markets are lovely. Actual production wins are lovelier. If Empower starts appearing in important hyperscaler designs, ADI's grid-to-core power strategy becomes much more valuable. If we hear mostly ambitious language without meaningful revenue, I would keep that $1.5 billion purchase under a much brighter microscope. There are geopolitical risks too. China represented roughly 26% of ADI's fiscal 2025 revenue by customer destination, while more than half of its wafer requirements come from outside foundries, including TSMC. So, despite ADI's American manufacturing footprint, this is not some perfectly insulated domestic semiconductor fortress. Longer-term US and China technology restrictions could push Chinese customers toward domestic alternatives. At the same time, trade policy and incentives for American semiconductor production may provide some strategic benefits to ADI. The company sits in a world where industrial policy can help one part of the business, while geopolitical fragmentation hurts another. The macro picture creates another strange split. Higher energy prices make efficiency, power management, and electrical infrastructure more valuable, which can help ADI's actual business. But higher inflation and higher treasury yields can make investors unwilling to pay premium multiples for future semiconductor profits. A stronger business thesis can therefore coexist with a weaker stock market valuation. So my final verdict is bullish, with a seatbelt on. Analog Devices is one of the semiconductor companies I'd be comfortable owning through a cycle. Its products are sticky, its margins are exceptional, its cash generation is excellent, and it has meaningful exposure to several trends that could last for years. But an excellent company and an excellent stock purchase are not automatically the same thing. At roughly $373, the market already understands a lot of what makes ADI special. The AI opportunity is known. The analog recovery is known. The institutional quality argument is known. There isn't much hidden treasure left for investors to discover. The opportunity may simply be patience. A normal semiconductor scare, a weaker data center quarter, higher bond yields, geopolitical headlines, or temporary industrial weakness could knock the shares down without destroying the 5-year thesis. And after watching an almost immaculate earnings report fail to push the stock higher, I would not be surprised if patient investors eventually get a better entry. So ADI goes into our post-earnings notebook as a long-term bull, an exceptional business, and a stock I would accumulate rather than chase. Around $335, I'd become considerably more interested. Around $300, assuming the thesis still holds, the risk and reward become very attractive. The lesson is simple: quality matters, growth matters, and the price you pay still matters just as much.